Hi everyone, this is the part 2 of chapter number 7, Momentum and Oscillators of CMT level 2. Before watching this video, make sure that you've checked the part 1 first. I'll link it in the description box below. In this video, we'll be completing the rest portion in this chapter. That would be oscillators, and then we'll just quickly recap whatever we've learned. So until now, we've been seeing what are momentum indicators, and now we'll see what are oscillators. Oscillating, what does the term oscillating mean? It's like a pendulum. So a pendulum goes this side and then goes this side. But you can see that the range is only between this and this. It keeps oscillating between the given range. That is what is the meaning of oscillators in general. Because the representation of momentum is that of a line fluctuating above and below a zero value, it has often been termed as an oscillator. Even though it does oscillate, the use of the word is confusing. In this presentation, the term oscillator will be restricted to a specific form of momentum that is normalized and expressed in terms of values that are limited to a range. So that's what I told you, there is going to be a fixed range between which the price can move. For example, between plus 1 and minus 1, or plus 100 or minus 100, plus 1 and 0, 100 or 0, as in a percent. So that is, you have a fixed range between which the price is going to move or the momentum is going to move. To transform a standard momentum calculation into the normalized form with a maximum value of plus and a minimum value of minus 1, divide the momentum calculation by its maximum value over the same rolling period. So if you want to classify it, what you're going to do is you're going to divide the momentum with the period of time. So what will that happen? If you divide it by the period of time, what will happen? What do you understand by the period of time I'm talking about? I'm talking about the maximum value that it has taken over this course of period. What is the maximum value? If you divide the momentum with the maximum value it took between this particular time interval, that is going to give you. Why is this helpful? Because in this calculation, volatility is taken into account, so you'll not have any sort of whipsaws in your trades. So that's what even they have written, to self-adjust to changes in price or volatility. For example, in April 2006, Amazon was trading at $34. During a 10 period, it had a high of 35 and a low of 31 and a range of 3.79. During 10 days in February, Amazon had a high of 191 and a low of 174 and a range of this much. Therefore, price move of a $2 in 2006 would be same as the move of $8 in 2011, because how much percentage of move happened before, you're going to keep that percentage into account rather than the price levels. Normalization is usually used in oscillators. Keep that in mind. And why do we use normalization? We use normalization because it's going to give you a value which is adjusting the price as well as volatility in it, and which will give you a better signal. The following sections show how a number of useful oscillators are calculated. Okay. So the first oscillator which we'll study in detail is the RSI, which is the Relative Strength Index. So overbought, oversold, we have discussed it briefly earlier, but we'll see that in more detail now. The RSI has been developed by Wells Wilder. It provides added value to the concept of momentum by scaling all values between 0 and 100. So the RSI oscillator, what happened when we created this, when Wells Wilder created this, one thing which made it easy for us was that the values are only going to be between 0 and 100. The values will not exceed these. And that's the way it has been created. It is a simple measurement that expresses the relative strength of the current price as increasing from 0 to 100. How do you calculate RSI? 100 minus 100 upon 1 plus RS, which is equal to 100 multiplied by RS upon 1 plus RS. They've taken the LCM. What is RS here? RS is relative strength, which is AU divided by AD, where AU is the total of upward price changes during the past 14 days. AD is the total number of downward price changes during the past 12, 14 days. Usually, whenever you have, even if you might have used RSI in your trading, you might have noticed that a 14 period RSI is the most common period which is used. You always use a 14 period RSI. So to find RSI, You are going to divide the total of the upward price changes in the given period of time, which is 14 days, divided by the total of the downward prices in the given 14 days. However, you need to keep in mind that the price change is always taken in the positive form. So relative strength is AU upon AD, where AU is the total upward price change in the past 14 days and AD is the total downward price changes. And what is the formula of the RSI oscillator? 100 minus 100 upon 1 plus RS. 100 minus 100 upon 1 plus RS, or 100 multiplied by RS upon 1 upon RS, which is the same thing. Okay. Once the first calculation has been made, both the AU and AD values can be calculated daily using an average of method. This is the average of method. AU of today is going to be equal to AU of t minus 1, which is the previous day, minus AU of the previous day divided by 14 plus the maximum value of today's price minus yesterday's price. What is MAX? MAX is a mathematical concept which is known as maxima. You need to learn these formulas because this can be tested in the MCQs. So average of method is when you're calculating the AU of today, which would be AU of yesterday minus AU of yesterday divided by 14 plus the maxima of today's price minus yesterday's price, 0. Similarly, if you want to find the AD, we already discussed what AU and AD are. AD of today will be AD of yesterday minus AD of yesterday divided by 14 plus maxima of today's price of yesterday's price minus today's price. Why are we taking yesterday's price first? Because decline in price is going to be negative, right? That's why. Because the difference is going to be negative, even though you are going to consider only the positive aspects. Why do people use the average of method? Let's talk about that for a second. The average of method essentially subtracts an average value and adds the new value, if any. All price changes are treated as positive numbers, be it decline in price or an increase in price. The daily calculation of the RSI becomes a matter of simple arithmetic. Wilder has favored the use of 14 days because it represents one half of a natural cycle. This is why we use what is a natural cycle? 21. So, why does Wilder use 14 days? Because it's going to give you the half of the natural cycle. In that case, a month. If you talk about a month. And also, you need to consider that the stock market has weekends. So, if you remove that and then if you half it, you can see that you get 14 days anyway. So, you just need to know that half of a natural cycle is 14 days. He has set the significant levels of RSI at 30 and 70. So the lower bound is at 30 and upper bound is at 70. When the price goes above 70, he thinks that it will go down. If the price goes below 70, by price I mean the RSI. If the RSI goes below 30, then you can look for buying opportunities. Again, everything is going to be dependent on the trend and the strategy which you are going to follow. Now let's look at figure 7.15. Wait, what was the, yeah, let's go to that. Use of the RSI alone to get trading signals often requires interpretation of similar to standard chart analysis. Lines are drawn across the tops of the RSI values to indicate a downtrend. A head and shoulders formation can be used as a temporary confirmation of a change in direction. So sometimes the RSI will give you a signal much before then the price actually gives the direction. So in that case, you can be tapped into the entry earlier. Now let's look at the image. Look at this image. This is RSI. You can see that the high was above 70 here, which means that selling pressure can start. Then there's a second high, and then there is a break of the support region inside the RSI. This is not the price, keep that in mind. So when this neckline got broken, you can assume that this is a sell signal. Studying the RSI is very similar to how we study the price. Let's also see what they have written. Wilder himself used the RSI top and bottom formations. A break of the reaction bottom between declining tops is a sell signal. Declining tops means lower highs and lower lows, change of the trend. The failure swing or divergence denotes an unsuccessful test of the recent high. Divergence, we have discussed that in the part 1. Now you can also see that Wilder not only created RSI, but he also made many more indicators like the ADX, which is the average direction movement. What is ADX? ADX basically talks about the direction. It talks about the directional movement, which will be discussed. Okay. Now let's talk about modifying the RSI. An obvious objection to the RSI might be the selection of the 14-day half cycle. Maximum divergence is achieved by using a moving average that is same fraction of the length of the dominant cycle, but the 14 days may not pay off the value. Like I discussed, there can be holidays in the middle, there can be weekends in the middle. So in any case, you can't be so sure that 14 is going to be actually the half period of time because of the change in the market conditions and the change in the market timings, and um, maybe someday there's a bank holiday, maybe someday there's a government holiday. So you can never really be so sure that the RSI is giving you the exact value. In practical terms, a 14-day RSI means that a sustained move in one direction that lasts for more than 14 days will produce a very high RSI value. If the price continues in the same direction, which means if the price continues higher for more than 14 days, then RSI will go sideways. The idea is to pick the calculation period for which there are few large sustained moves. If there are many large moves, then again, you might not ever get an entry signal. While Wilder gave us the lower band and upper band of 70 and 30, people have also used 80 to 20. Let me show you guys the indicator to understand better. Okay, let's actually see this. We have anyway discussed this. So there is a dotted line above and a dotted line below. The below one is 30, the above one is 70. So if the price goes above that, you can assume it will go down. If the price goes below this band, you can assume that it will go up. If you click on the RSI settings, you can see that the length of the RSI is 14. This is what I was telling you because we are using a 14 period RSI. If you want, you can change it. And then, if you want to change the upper band to 80, and if you don't want a middle band, and if you change the lower band to 20, then this is how your chart's going to look. See, in this case here it didn't go above it. So it's all on you how you want to customize it. Sometimes people use 80-20, sometimes people use 70-30. So it's up to you what works for you. Make sure that you backtest and see what works for you and for your time frame. All right. Further smoothing with end day ups and downs. Instead of increasing the number of days in the RSI calculation period, which is increasing the number of days, means instead of using just 14 days, what if I use more days than 14? While you can do that, that has its problems on itself. So a smoother indicator can be found by increasing the period over which each of the up and the down values are determined. The original RSI method uses 14 individual days, where an up day is a day when the price change was positive and a down day is when the price change was negative. We can replace each 1 day change with a 2 day change or an end day change. So if we use a 2 day change, then the total of 28 days will be needed. So 2 day period does not overlap each other. There will be 14 sets of 2 days each. So that will give you, if you use 2 days instead of 1 day change, then you will also need a period which is double of the 14 period which we have been discussing. What will happen? That will just give you a smoother answer. Okay, take a moment to read this. RSI counter trend trading. Read till from here to here. I'll just be back. Okay, I'm back. So now we'll talk about what is counter trend trading. If there is an uptrend going on and if I am looking for short opportunities that is going against the trend, or that is a counter trend trading, so that is counter trend in an uptrend. In a downtrend, if you start buying, then that is again a counter trend activity. So for that purpose also you can use RSI. Momentum indicators are used for timing and counter trend trading. Normally, it is absolute overbought or oversold level that will trigger for a trade. However, either a fast move in the price as an extreme value could be criterion for reversal. When RSI of today minus the RSI of that day is greater than A, or when RSI of today minus RSI of that day is minus A. What is A in this? A is a threshold value. Then we could buy and sell respectively. A is the value which you will choose by yourself. This also increases the number of trades because it does not require that RSI should be greater than 0. Exits can be taken when momentum returns near 0 or when end days. End days, again, it's on your discretion. Net momentum oscillator. Another variation on the RSI is to use the difference between the sum of the up days and the sum of the down days, called a net momentum oscillators. So what is a net momentum oscillators? If you are going to sum the number of up days and you are going to sum the number of down days in the given period, and you calculate the difference between it, then you get a net momentum oscillator. If you consider the unsmoothed RSI, then the net momentum oscillators would be net momentum, or CMO is net momentum oscillator. 100 multiplied by SU minus SD divided by SU plus SD. What is 100 multiplied by SU divided by SU plus SD? If you are getting confused, always just go back to your notes and see the initial formula. 100 multiplied by RS, 1 plus RS, where RS is the total upward price changes divided by the total downward changes. Okay, 100 multiplied by SU minus SD divided by SU plus SD. This is going to give the CMO, which is the net momentum oscillator. This method replaces some of the indicator moment lost due to the smoothing or the normalization. Now let's talk about what is the 2-day RSI. Among the interesting information published on MarketSci blog is Michael Stokes' favorite indicator, the 2-day RSI. I just told you what 2-day RSI is. Instead of taking a 14 period, you're going to take a 28 period. Closing price change within a 2-day change, instead of just one up day, second day was a down day, instead of like that, you are calculating the change in the price according to on a 2-day basis instead of individual days. Sometimes if you don't want to use a 2-day period and you want to use, let's say, a 3-day period or a 4-day period or how many ever n days period, that is also possible for you to do. You can do that by your own. Stokes uses threshold levels of 10 and 90 for the S&P. 10 and 90, upper band and the lower band, instead of 70-30. Buy on the next close when the 2-day RSI penetrates the threshold of 10, moving lower. Sell short on the next close when the 2-day RSI penetrates the threshold of the 90, moving higher. Just like how it was working. And when are you supposed to exit? You are going to exit on the close after the penetration. If you're finding this topic difficult and if you're not able to understand, then there's just one thing which can help you. That is reading the entire lesson by yourself after watching this video, and also going to TradingView and trying to backtest whatever you are learning. That is the only way you can excel. Okay. Let's come to this now. A standard 2 period RSI. So in this figure given, we have 2 period RSI in the middle. This is the 2 period RSI. Hope you can see it. And this is the chart of Nasdaq futures from August 2005 to September 2008. The classic RSI penetrates the extremes of 30 and 70 but does not reach 20 or 80, while the 2 period touches 15 and 85 a number of times. We might expect a 2 period oscillator to jump between 0 to 100 every day that prices change in direction, but the average of calculation slows down the process and makes the 2 period chart more valuable. So if you can look at this was touching it here, 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 whereas here there was no touch at all. So that's what happens when you smoothen the data. So this is RSI applied to the spread between a 10-week and 40-week moving average of the S&P futures. Okay. An RSI version of MACD. While MACD creates a histogram of the difference between two moving averages, we can make that pattern easier to interpret by applying the RSI to the spread of the moving averages. A 5-day RSI is applied to the difference between the 10 and 40-week moving average for the E-mini S&P futures. Again, let's look at the figure. This is my figure. What they have, the RSI which they have plotted here is the difference between the 10 and the 40 moving averages using the 30-70 threshold. 70 is somewhere here, 30 is somewhere here. Now let's come to stochastic. Stochastic is a very nice indicator, and stochastic is actually created by George Lane. It is an oscillator again, and that basically measures the relative position of the closing price within a past high-low range. So only the closing prices are taken into account when we are talking about the stochastic oscillator. And it talks about high and low range in the given range. It is based on the commonly accepted observation that the closing prices tend to resist penetrating the high prices of the past few days, the place where a horizontal resistance would be drawn on a chart. Similarly, in a downtrend, prices must be able to close below the lows of the past few days. So if the price closes above the high of the range days, if the price is able to close above the high of the past few days, then we can say that an uptrend has begun. And if the price is able to close below the lows of the past few days, then we can say that a downtrend is going to start. That is how we basically use a stochastic. That is the logic behind how stochastic is calculated. And one more thing to keep in mind, stochastic is talking about the closing prices, penetrating the high and then going down again. That is also a possibility, right? So when we are talking about stochastic, we are not only seeing the high and low prices, we are saying that the price makes sure that it closes above or below the highs or the lows in order for us to determine the direction or the strength of the particular trend, be it upside or downside. When the market is about to turn from up to down, it is often the case that the highs are higher than previous days, but the closing price settles near the low of the day, failing to indicate a continuation of the uptrend. Now, I can give you a good example of this right now on the gold chart. So, look at this. The price has been clearly rallying. Where's the pen? Yeah. The price has been clearly rallying. And this high, this high, this high. Let's talk about this latest high. The price is over here. The price is breaking through it, But we cannot say anything about it until the closing happens. If the price actually closes above this high, we can say that it is in an uptrend. But sometimes the price will just wick and then go and close down. That will show that the uptrend is gonna be over. This makes the stochastic oscillator different from the MACD, which uses the difference between two trends, and the RSI only uses the closing prices. The stochastic uses the high-low close, unlike the oscillators. There, they do not have to be any smoothing. So, when we were discussing about RSI, we never spoke about the high prices or the low prices. But we only saw the closing prices. But when you are talking about the stochastic oscillator, it also includes the fact that the price closing is one thing, but the price also has to close above the highs of the previous days. So, stochastic oscillator is taking into account the highs and the lows of the previous days, not just that the price has to cross the high. It says that the price has to cross the high and also give us a strong closing. So that's the difference between RSI and stochastic. In RSI, we only see the closing prices. In stochastic, we see the closing price with regard to the high and the low. The three indicators that result from stochastic measurement are called K%, D%, and D% slow. D% being the most popular as a single indicator, D% and minus D% are often used together to produce a trading signal. Let's see how to calculate it. K% is 100 multiplied by today's closing price minus the low of the last 5 days divided by R5, which is the range of the last 5 days. Whenever I talk about the range of the last 5 days, range is basically the first price minus the last price, or the high price minus the low price. So how are you going to calculate the K%? K% is going to be 100 multiplied by 100 multiplied by the closing price of today minus the low of the past 5 days divided by the range of the last 5 days. This is the K%. And what is D%? D% is K% of today plus K% of yesterday plus K% of the day before that divided by 3. And if I want to find the summation of it, then I get the D%. What is D% minus or D% slow? It is the summation of the D divided by 3. Take a moment, write down these formulas and try to learn it along with this video itself. K% is 100 multiplied by the closing price of today minus the low of the last 5 days divided by the range of the last 5 days. D% is the K% of today plus the K% of yesterday plus the K% of the day before divided by 3. And what is D%? D% is D summation of the D plus D% divided by 3. Now again, if you want to know what is K, D and D dash, you can see that they are stochastic measurement related indicators. Okay. Calculating the 10-day stochastic for Hewlett-Packard HPQ. Using an Excel spreadsheet, each of the stochastic components can be calculated in only a few columns. In table 7.1, the historic prices of Hewlett-Packard are imported into columns A to D. The 10-day stochastic calculations, columns E to J, are column E is the 10-day high, maxima, minima, and then you find the high and the low range like we discussed, and then you find the K% and the D% and the slow D%, all of it, and the average is always divided by 3 because you are using a 3-day average. Look at this. Date, high, low, close, 10-day high, 10-day low, 10, K%, K slow percent, D%. You need to know how to calculate these formulas. Now let's compare the stochastic to momentum and the RSI. The calculation for momentum, RSI and stochastic are very different. Therefore, we would expect the chart of these indicators to vary considerably. However, if you actually plot all of these and you look at the chart, you can see that all of them look just the same. They are plotted exactly the same. They look the same, even though the calculations are very different. The momentum and the stochastic both show how today's price relates to the prices over the calculation interval. Therefore, we would expect them. Wait, I think a page is missing. Let me just quickly check if it's missing or this is it. Chapter number 7, Momentum and Oscillator. Yeah, a lot of it is missing here, but I will scan it and I'll cover it. But for now, you need to understand that stochastic, momentum, RSI, all of them look just the same and they're plotted also just the same.